In this example, I'm going to show you guys how to do a project analysis for capital budgeting. The company that I chose was Molson & Coors Company, or TAP. The project that we're going to propose is to do a snow cap brew kit. Okay. As you can see, I laid out this spreadsheet already to try to make it a little bit quicker in time. Okay, so it's already set up, but I'll still go slow. The first thing that we want to start with is our inputs. And the first one, important one, is our initial outlay for equipment. So we probably need equipment to start building these snowcap brew kits, right? Well, I'm going to assume that that's going to cost us $32 million. But we also could have a salvage value, right? So what are we going to sell that for at the end of our project? And this project is only going to last us 5 years. So I'm going to say that we can sell it for $18 million after its use. Initial capital, working capital used, that's basically saying how much working capital we need to start this project. I'm going to say $750,000. Working capital percentage, now that's based on your revenue. So when your revenues are going up and down, your working capital needed are going to go up and down, right? Let's assume that it's going to be 6% of our revenue. To make this nice and easy, I'm going to use 10 years depreciable life. Now we can calculate our depreciation per year. That's simply just the $32 million that it costs us to buy the equipment divided by our depreciable life. Make sure you're not doing this in your head and you're actually doing it on Excel. So I'm getting 3.2 million. Some people might be asking, why didn't I do 32 million minus 18 million divided by 10? Well, we're assuming that we're going to have zero salvage value for now. We want to kind of, accelerate our depreciation. Any company would do that. But we will realize maybe a gain or a loss later on the sale of equipment. Okay? So for now, that's how you're going to do it. You're going to do the initial outlay divided by your depreciable life. So that's why we got 3.2 million. We also need to know a cost of capital. For now, I'm going to assume an 8% cost of capital, and I'm going to assume a 34% tax rate. I also am going to put 100% into this percent change in sales, and I'm going to tell you about that in a second. So our next section that we want to go on to is our cash flow from operations. Because remember, the whole point of doing this project analysis is to find our free cash flow. And we know free cash flow from an asset perspective is your cash flow from operations minus your change in net working capital minus your change in gross fixed assets. So I laid out 3 sections that way. That's why this first section here is cash flow from operations. The next section is net working capital section, and then the last section is your gross fixed asset section. And then I put them all together in free cash flow. So it's laid out nice and easy for us. You can lay it out however you want as long as you're getting the right numbers. But for visual purposes, I figured this would be the easiest way. So let's get started on our cash flow from operations section. As you can see, we have years 0 to 5 because we're assuming a 5-year project. So we know that we're going to sell some units in year 1, and we're going to assume that we're going to sell 500,000 units. In year 2, we're going to sell 600,000 units. In year 3, 800,000 units. And 1,025,000 units in year 4. And lastly, we're going to go down to 975,000 units in year 5. And that kind of makes sense because if all of a sudden our units drop off, we might not want to keep that project going on because it might just keep decreasing, Okay. And now, remember when I said this percent change in sales, that's 100%? This is where we're going to use it. I put this in here because we will be doing sensitivity analysis saying, you know what, maybe you might want to expect 80% of sales. Or maybe you'll expect sales to do better than what you previously expected. So you might want to take that up to 120% of sales. And that's what this is for. So what we want to do is we want to take this $500,000, or I'm sorry, 500,000 units, and multiply that by this 100%. But I'm going to anchor this 100%, or E9, cell E9. And what I mean by anchor is I'm going to put a dollar sign before the E and after the E, or before the 9. So it reads C14, which is our 500,000 units, times dollar sign E dollar sign 9. And that's going to keep that cell in that formula when I go across. So now I can just drag across. See this little black square in the bottom right corner? And when you put your cursor over it, it turns into a black cross. You can drag that right across. And that 100% is actually going to stay in that cell multiplying. I can show you guys, actually I'll show you guys right now what would happen if you didn't do that. So let's just put in E9. So when I don't anchor it, I go across. See, we're not getting what we want because technically in this year 2, it's taking the units sold, 600,000 times F9. We don't want that, right? That's why we anchor it. We want it to stay in E9. So I'm going to go back and do that again. Let's anchor that E9. Perfect. I'm going to drag across, and there we go. And see how it's 100% or it's multiplying by 1. That's why they're the same. Now you can see if I said, I expect sales to actually go up instead, say to 120%. See how they're increasing? Okay. I'm going to put that back to 100 though. Okay. Now we also want to come up with a price per unit. Since we're doing snow cap brew kits, we figure, this is probably going to be a pretty pricey item. So I'm going to say $55. That's in year 1. In year 2, we're going to raise it to 57. Year 3, we're going to go to 58. Year 4, 59. Then, since we know our sales are going to drop off, we're going to actually put it down to 57. Okay, our variable costs. So that's more like our cost of goods sold, how much it's costing to make the product and whatnot. So $42, $45, 45, and then year 4 is going to be 46, and 46 in year 5 as well. Okay, now our fixed costs. I'm going to assume that we have $2 million in fixed costs in year 1. That's going to stay constant in year 2 as well. Year 3, they're going to go up to 2.5 million. In year 4, 2.5 million again. And then lastly, they're going to go back down to 2 million in year 5. Just because we're not selling as many units, we're not making as many units, so we might, even fire some administration or something. Not necessarily fire them, but relocate them so they're not really doing anything with allocating anything to the project. So that there's many reasons why that might go down in year 5. Okay, so now we can calculate our sales or our revenue, whatever you want to refer it as. And all that it's saying is it's going to be the selling price of $55 in cell C16 times how many units we're selling. And we're going to use the units sold percent change. And that makes sense because, if we do that sensitivity analysis, we want that to carry forward. Okay? As you can see, I'm doing everything I possibly can in a formula as well. Because when we change an input, we want everything to change with it. That's why we're not doing any calculations by hand, or in our head, or calculator. We're using Excel and everything. Okay, so that's 27.5 million. And I didn't anchor that. I need to anchor. Oh, actually, I don't need to anchor anything there. I can just drag. So we just drag across, and there you go. We're going to do the same exact thing for variable costs. So that $42 times 500,000. And remember C15 or units sold percent change. Okay, and then we're just going to do equals our fixed costs. We already found them. See, I'm still using a formula for that though, because I might change my fixed costs. You don't know. And if I change in one place, I want them to change everywhere else the fixed costs are supposed to be. And drag that across. Now we can find EBITDA. That's simple. That's just your sales minus your variable costs minus your fixed costs. So C20 minus C19 or C21 minus C22. Or 4.5 million, and I can drag that across. It's going to do it for the rest. Perfect. And our depreciation, we just calculated that, so I'm going to do equals, and I'm going to click on B9, but I'm going to be careful here because I want this anchored, right? I want 3.2 million in every single cell because that's our yearly depreciation. So I'm going to anchor that with dollar signs. I'm going to drag that across. And now we can calculate our EBIT, which is just our EBITDA minus our depreciation. Now we're going to assume that our EBIT is our taxable income. So we're going to take our EBIT. Actually, let me carry that all the way across first for all the years. Okay, now we're going to take our EBIT and multiply that by our tax rate. And we have to anchor that in E5. So dollar signs. And I'm going to drag that across. And now we can find our earnings, which is just our EBIT minus taxes. Drag that across. Okay. Now we don't really need our earnings for our cash flow from operations section, but it's just nice to see. because what we're going to do is we're actually going to take our EBITDA, which we already calculated, and just subtract our taxes. So like I said, I'm going to do as many formulas as I possibly can do, because if EBITDA changes, I want it to change down here as well. So I'm going to take EBITDA, what we already calculated, which is C23, and bring it down here. And I'm going to go all the way across with that. And we already calculated taxes. And now I said I have the taxes in parentheses because I kind of like to see it as a negative. It's just good for, it's easy on my head. So what I'm going to do is equals negative our taxes, or negative C28, and see how it's coming in as a negative, and I'm going to take that across. Okay, now we can find our cash flow from operations, which is simply EBITDA minus taxes. Now I'm going to do equals this 4.5 million, and see how it's already a negative for the 442,000. So I'm actually going to hit plus, okay, and that's actually going to subtract it out, which is what I wanted, and drag that across. You just finished cash flow from operations. So now we only have two small sections left. Then we can find our free cash flow. Okay, so our next section is our net working capital section. Let's start with initial working capital. I'll tell you why in a second, but we actually said we have an initial working capital, and that's up top. So it equals, and I'm going to click on the 750,000. Okay, and now what I want to do is I want to bring down my revenue that we had before. Okay, so like I said, that's a formula. We're going to drag that across. And the reason why I did that is because this net working capital needs right here in A42, we're going to take a percent of that revenue, which we said was our working capital percentage. So I'm going to take that 27.5 million, or C40, and multiply it by that 6% of working capital percent. But we want to anchor that as well because we want it to stay in that cell. And we're going to take that all the way across. Perfect. Now we want to find our change in net working capital. So obviously in year 0, it's just that 750, right? Because we went from 0 to 750,000. In year 1, we went from, well, let's just say we go from 750,000 to that 1.65. So that's an increase in net working capital, right? So that's that. It's more recent time minus the year prior. So it's a C42 minus 750. And in year 2, what we're going to do is that year 2 net working capital need of 2.052 million, subtract that out from the year's 1 of 1.65 million. I'll give you the 402,000, and now I can drag that across. Perfect. Now there's such thing as a liquidation. Liquidation of our net working capital. Basically what that's doing is it's taking year 5, we have 3.34500 of net working capital. And we're going to free all of that up in year 5, right? Because we're ending the project. So we're going from 3.345 million to 0. So I'm just going to say negative that cell. Okay? Now I'm just going to bring down our change in net working capital needs, right? And that's just these two rows. The change in net working capital and liquidation I need to worry about. And that's actually going to be a negative 750,000 minus a liquidation value. I'm sorry, plus a liquidation value. It's before, I'm sorry, I screwed that up, guys. It's change in net working capital plus liquidation. And the reason why that is because think of our formula. It says cash flow from operations minus a change in net working capital, right? So if it's a minus, a plus, it's minus the use of cash. But when you have a minus, that's a source of cash. You're getting cash back, so free cash flow would actually go up. But see how we have that 750 change in net working capital? We use 750,000. So our formula will actually be that minus 750,000. It might become clear later on in the road. But let me drag that across. And you can see in year 5, we're freeing up 3.628,500 in cash, right? Because that's saying we're freeing up all that liquidation, and we're also freeing up that 294,000 from that change in net working capital. Perfect. So there you go, another section done. Now we're on to gross fixed assets. Now our gross fixed assets sections, we want to find, first off, a purchase of our equipment, right? And that's in year 0. So I can already put that in. And that's going to be a positive as well, because if you think about it, uh, our formula is cash flow from operations minus your change in net working capital minus your change in gross fixed assets. Well, if you spend something, it's going to be minus a positive, right? Because we're using up cash. So free cash flow is actually going to go down. So our purchase of the equipment was up top here at 32 million. So I already know that's going to be there. Okay. So now let's find out what our sale of equipment will be in year 5. So our sale of equipment, we said we have a salvage value for that, so that's up top of 18 million. The book value of the asset, of the equipment, I should say, or asset, whatever you want to call it, that is simply what you pay for it, or that 32 million minus the sum of all of your depreciations. So 5 years of depreciation, and close that off. Okay. So the book value of our equipment is actually 16 million, and we sold it for 18 million. So I already know it looks like we're going to get a gain of 2 million, but I'm just going to calculate it anyway. So that's that 18 million minus that 16 million. So we have a gain of 2 million. And we already know our tax rate. That's up top, right? So I'm going to put equals the tax rate up top. And now we have to find the tax impact on sales, right? And I'm going to say this formula is actually equal to negative B52 times our tax rate. And the reason why I put a negative is because think about what we're doing. A minus is a positive, right? So this negative is actually it'll be easier if I show you in a second. So anyways, we have to pay 680,000 in taxes, right? And that's why I did it that way. So it's more like how I like it up top. So when I wanted to multiply it by a negative because then I know it's kind of like an expense to me. Okay, so our cash flow from sale of equipment, and that's simply equal to this 18 million. It's actually a negative 18 million minus this tax impact on sale. So a minus is a positive, right? So let's go back to our formula. When we have a minus, it's a source of cash. That's why that 18 million we want is a negative. And that's so then we subtract out this negative. That's actually going to be a positive. So it's actually saying your free cash flows is going down 608,000. That's why we do that. So you can kind of see how it eats into here. So we sold it for 18 million, and then we had to pay $680,000 in taxes, or we get a gain of 17,320,000. Remember, a negative is a good thing in this case. It's a source of cash. We're getting that back because it's a minus. A minus at 17.32 million. So that means free cash flow will actually be going up. Okay. And we're going to put that in, we have that in the sale of equipment, right? So let's put that in year 5 for that. Equals this cell. And then I'm just going to carry these down. So I'm just going to plus these cells. And I'm going to carry that all the way over. Perfect. And now we can just figure out our free cash flow since we have all 3 sections. So we know cash flow from operations is up here. We're going to start with B35 since we're in year 0. And drag that all the way across. Same thing with change in net working capital. That's in B45, that's 750,000. And I can drag that across. And then change in net working capital is just here, that 32 million starts with that in year 0, and we're going to drag that all the way across. And now we can calculate our free cash flow. Now this is where you might actually see what I mean by that minus. Because free cash flow is equal to cash flow from operations minus change in net working capital minus change in capital spending. So we actually have a negative free cash flow for year 0, which makes sense, right? Because we put all this money into our project, so it would make sense that we have a negative free cash flow since we didn't have any revenues or anything. So let's just drag that across. And now let's look at year 5. This is where it might be more clear. Our formula says cash flow from operations minus change in net working capital, so that's a minus 3.6. Minus change in capital spending, so that's a minus 17 million. So that's how we get a positive 27,795,000. Okay, so that's where all those minuses. I know they can get a little tricky, but you can see it there. So now let's calculate our present value of cash flows. And that's simply the PV, which is a formula that's in Excel. And then you just open up your parenthesis, and they ask you for your rate. Our rate was actually all the way up here, which is the cost of capital. That's what we're using as our rate. And we want to anchor that, because when we go across, we want it to stay there. Okay. Our period, which is obviously just you click on the year, comma. We don't have a payment, it's lump sum. And our future value is this free cash flow. And just close that off. And as you can see, obviously, I had to put negative because we always put negatives in present values, right? And obviously that makes sense, right? If it's year 0, it's not going to be discounted any. But now I can drag that all the way across, and I anchored our year, or I'm sorry, I didn't anchor our year because we didn't have to, right? But when I carry it across, it's going to show up as 1, 2, 3, 4, 5, so it'll discount accordingly. Great. Now I'm going to show you a different way that you can actually use your formulas as well. If you don't like the whole present value formula, you can also do it this way. You can do equals, and you can take this 3275 and divide that by parenthesis 1 plus, and that's where you can go up top and hit your cost of capital. We're going to want to anchor that. So when we move across, that doesn't change. Close your parenthesis, scroll back down. We want to raise that, so you use your little caret and then raise it to the year that you're in. Okay, see how it's still the same? And watch when I drag it across, all the values will still be the same. Because it's the same formula. It's either, you can use the Excel formula, you can just, if you just know that present value equals future value over 1 plus I to the t, you can use that too. I personally just use the formula because it's kind of a pain just to keep typing in all the formula that Excel asks you for. Okay, now just ignore these colors for NPV, PI, and IRR. I kind of did a conditional format. I'll tell you about that in a second. But the two reds that are located on here will be changing. But let's calculate NPV, and that's simply the sum of your cash flows. So everything, including the initial outlay, right? So we have a positive NPV of $2,473,451. Our profitability index, that is equal to the present value of our cash flows from year 1 to 5, right? So that's the sum of that. So we don't include our initial outlay in this because we're going to be dividing by that, and we're going to divide by a negative since our initial outlay is already in a negative form. And look at that. See how it turned green? That's the conditional format, and I put it in a rule that said, NPV is greater than or equal to 0, turn green. If PI is greater than or equal to 1, turn green. Then IRR, I put a rule of if it's greater than your cost of capital, make that turn green as well. And then if any of them do not meet that condition, they turn red. So IRR is actually a function of Excel. So it's equals IRR, open parenthesis, and then the free cash flow line, you just highlight every single one of those and close that off. Hit enter. And as you can see, it goes to 10.01%. And 10.01 is greater than our cost of capital of 8%. So obviously you can see that we would accept this project since it does have a significantly large NPV, has a decent profitability index, and our IRR is greater than our cost of capital. But what happens if we say we were a bit optimistic? Maybe our sales will only be 80%. So that's where this function comes nice. And you can just put 80 into the percent change in sales, hit enter, and everything else is going to change with it, everything that's supposed to anyways. And you can see right away that, wow, NPV is now negative, profitability index is below 1, and our IRR is actually less than our cost of capital. So if we only expect 80% of what we normally wanted, then we're not going to accept this project. So this is where sensitivity analysis can be very beneficial. Let's go back to 100%. We can also play with a lot of different things, right? We can even play with our cost of capital. Say cost of capital goes to 15%, which is very, very high. Let's see what happens when that happens. We have negative NPV as well. Okay, so let's put that back to 8%. Say our initial outlay for equipment, we talked to the company, they told us 32 million, but then you go back and they're like, no, sorry, prices changed to 40 million. See what happens when that takes place. And even with that, that takes us to a negative NPV. So you have to be very cautious of what you're putting in here, right? See how sensitive this Excel sheet can be? Sorry if I just made you guys dizzy by scrolling, but so that's basically it of capital budgeting. If you guys have any questions, make sure you email us so that we can get another one up here. And I hope you guys all master it now.